industry has been revolutionized through technology, except for finance. So it's our turn to revolutionize finance, and I think that crowdfunding is going to be a very, very, very large part of that. So who is Realty Mogul? We are the largest crowdfunding company in the United States right now for US investors. We are limited to accredited investors. So in the US, accredited investors have a net worth over $1 million or an annual income over $200,000. It's a little bit different than the definition in Canada, but just holistically, it's high net worth investors. For the attorneys in the room, we're using an existing exemption in the United States market called Regulation D506. It's similar to what Oscar was talking about with the exempt market dealers in Canada being able to offer securities to accredited investors. So a similar structure for what we're doing in the United States. In the last 6 months alone, we have underwritten over $700 million of private real estate transactions for individual investors in the US market. Of that $700 million, we've invested in about $40 million of property value. This is our statistics page. I think we're actually the only crowdfunding company in the country, at least in the US, that has gone public with our statistics. I am very, very, very open as a CEO. I'm very transparent. I'll tell you almost anything that you want to know, assuming that I know the answer. And if I don't know the answer, I'll get the answer. But we went public with our statistics very, very, very early when we really had no traction. And some of our investors said, "You're absolutely nuts. You know, why are you telling people you've only done $300,000 in transactions or $1 million in transactions?" And I said, because we're going to do $100 million and I'm not worried. And we want to show our growth from day one. So we went live with our statistics. I pulled up a screenshot for you here. We've made 23 investments. And I think most importantly, we've already distributed back over $500,000 to our investors. We are also one of the only crowdfunding companies, if the only crowdfunding company, that has done that. And it's because we strictly focus on cash flow. So we will not invest in a development project. We will not invest in a major repositioning project. Everything that we're investing in has current income and current cash flow. And this goes back to that theme around the economy right now, where investors were telling us, I want a monthly check. I want a quarterly check. I want it to be consistent. And I want to know where the income's coming from and when the income is coming. So that's really what we focused on doing. We're also very, very big on diversification. And we diversify across 3 main axes. It's the 3 pie charts here on the bottom of the screen. The first axis is the property type. We are comfortable in almost every single type of real property, whether it's residential, multifamily, a retail shopping center, an apartment building, an office building, a self-storage facility. We're comfortable so long as there is cash flow. The second axis is geography. We're in a host of states in the United States today: California, Tennessee, Texas, Kansas, Washington, Illinois. We're also in a variety of other states in the Midwest. And we're looking to be, at least today, a national platform in the United States. So looking to acquire in any market where we think the real estate market makes sense. That doesn't mean that we'll be in every state, but it means that we have a very, very broad reach of what we look at from an underwriting perspective. The last axis that we diversify on is investment type or asset type. We are a crowdfunding company that does both debt crowdfunding and equity crowdfunding. So equity crowdfunding, a lot of us has been talking about that today. I'm not sure that anybody spent a whole lot of time talking about debt crowdfunding, but in my opinion, debt crowdfunding really started with 2 now large peer-to-peer lenders in the United States, Lending Club and Prosper. Prosper's done, I think, $600 million in unsecured consumer debt, and Lending Club has now done over $2.5 billion. So along that trend, we are doing loans that are secured by real estate. Both of those companies offer unsecured consumer debt, and all of our loans are secured in what's called first position by real estate. So we have a debt piece of our business, and we have an equity piece of our business where we're offering preferred equity in commercial transactions, apartment buildings, retail shopping centers, and the like. Now, one of the reasons that I'm really, really interested in real estate investing is to give investors the opportunity to be passive. Really what that means is that you're not dealing with the hassles you're not dealing with the hassles of property management. And if you think about this from decades, this has existed way, way, way beyond crowdfunding. Crowdfunding is pooling capital to make an investment. And this has been happening in the real estate world, again, for decades. Families have bought and sold properties together. Friends have bought and sold properties together. You even think about publicly traded REITs, or real estate investment trusts, which are traded on the public equity markets. Those are investors jumping in and collectively buying properties together. So this isn't a new phenomenon. It's a new phenomenon, it's a different phenomenon for 5 primary reasons. The first is the ability to transact online. Historically, you could not make these types of investments online. You could invest in stocks and bonds online through E-Trade, Scottrade, Fidelity, Merrill Lynch. I'm not sure the largest online broker or exempt market dealer here in Canada, but I'm sure it exists. So the online aspect is really, really big. The second access is the second difference is unparalleled access to deal flow. If you wanted to invest in this kind of investment historically, you had to have a relationship. You had to know a real estate company that was actively raising money in a project that you could get access to. And that has completely shifted with crowdfunding. Our team goes out and scours the entire United States for projects to bring to our network of accredited investors. And these are all transactions they would not have been able to invest in without us. They just wouldn't have had the access, they don't have the relationships, they don't spend their full-time jobs going out and finding passive real estate investments the way that our team does. The third difference between real estate syndication or collective real estate investment of the past and crowdfunding today is lower minimum investments. We offer investments at $5,000 or $10,000. And historically, if you wanted to invest with these real estate companies, it could be $100,000 or $250,000, $250,000. And what's really interesting about this is back to that concept and that idea of diversification. Even though we're working with high net worth investors who can write a $100,000 check or a $250,000 check, I would rather see that investor write $10,000 checks and get diversification than write one $100,000 check. And that's very, very different in real estate crowdfunding, is that ability. And really, it's technology. The reason we can do that now is because it's scalable through technology. Number 4 and number 5 are increased transparency and 24/7 access to investor reporting and money management. Here's a screenshot from our website. This is an actual investor. You can't see who it is, but this is an actual investor who's active with us on his investment portfolio. And this gives him full oversight of how his money is working for him. As I mentioned, we're very focused on cash flow, so one of the primary things that we highlight is cumulative earnings. How much money has he made with us in the last 3 months? We're also showing him his account value and showing him how he's diversified across those 3 axes that I talked about. You couldn't do this historically with real estate syndication. You couldn't take 10 transactions from 10 different real estate companies and get a holistic overview and be able to compare and contrast those assets really, really easily. So we're doing what the online broker-dealers have done in the stock and bond world for a private transaction, and it happens to be a private real estate transaction. My favorite thing about crowdfunding in real estate is that it's passive, and that it means that investors are not dealing with the hassles of tenants, toilets, and trash. Quick personal story here. I manage an apartment building on behalf of my family in Los Angeles. This is a true story. Less than a month ago, Saturday night, probably 1:30 in the morning, I get a phone call. My immediate gut reaction is crap, right? Anytime you get a phone call at 1:30 in the morning, something's bad. There's a health issue, somebody's got a problem. Sure enough, our main water pipe into the building burst. 1:30 in the morning on Friday. So I say to the tenant, can we deal with this tomorrow? No, there's water going everywhere. We can't deal with it tomorrow. I have to deal with it right now. This minute, you need to be here immediately. So I throw on clothes, I go over to the property. Of course, I call a plumber. It's $500 an hour because it's after hours. You know, now it's 2:30 in the morning on a Saturday. Turns out our main water pipe actually did burst. We now had to rip up the entire driveway. We had to put in a main water line from the street back to the property. Literally, I'm dealing with all this while also, running the company. And it really solidifies for me how powerful crowdfunding can be in real estate, where you can get investors access to these types of transactions without dealing with the day-to-day. They can keep their day job and they can be entirely passive. So what are some of the pros and cons of crowdfunding for real estate and passive real estate investing? The first one, I think, is the most important on the pro side, which is leverage the smarts of others. I'll share an example. We recently made an investment into Texas. It was our first investment in Texas. And the company that we're invested with owns 11,000 apartment units in that market. Collectively, the principals have done over $2 billion in real estate. For one of our investors to get that kind of access, or for one of our investors to learn the collective intelligence that that real estate company has, it would take decades. I mean, they've been at this for decades, and we're able to leverage their intelligence and leverage the collective intelligence of their business model. Some of the other pros are, again, hassles of tenants, toilets, and trash. Make money while you sleep. We are generating income so long as the tenants are paying income. In an apartment building, they're paying you to sleep. They're paying you to wake up. They're paying you to eat there. In a shopping center, you've got tenants like grocery stores and sandwich shops. They're also paying you rent day in and day out. Another one is do it from the convenience of your home. And I'll share another interesting story. It's a Saturday morning, 7:30 in the morning, and I'm going to have breakfast with my co-founder in the business. And he calls me, and he goes, someone just wired us $200,000. This is very, very early in the business. We started the business in March. This is probably like April 1st. I go, you're nuts. Who's crazy enough to wire us $200,000? You know, with our stats page saying we'd done all of, $50,000. And he goes, no, someone just wired us $200,000. And I go, have you talked to him? He goes, no, I looked in our database, I've never talked to him. I go, have I talked to him? No, you've never talked to him. Have you ever emailed him? No, I've never emailed him. Have I ever emailed him? No, you've never emailed him. Who is this guy, right? So I said, okay, I'll call him first thing Monday morning. I call him first thing Monday morning. I say, Jake, you just wired us $200,000. Thank you so much for being a Realty Mogul client. I'm the CEO. If I can ever be of assistance, I'm more than happy to help you. And the first thing out of his mouth is this a fraud? And I go, Jake, you just wired us $200,000. And you're asking me now, is this a fraud? And I go, it's not a fraud. We're a legitimate company. We're just getting started. Thanks for being an early adopter. And I said, I'm really interested in learning. Why didn't you call us or why didn't you email us? You just kind of trusted us and wired us $200,000. And he goes, I don't want to talk to you. I'm doing this because it's online. And I can sit in my underwear and do it in my living room. And I'm doing it because it's online and because I don't want to have to talk to anybody. I don't want to have anybody selling me. I want to make my own decision and I want to make the investment. And that's one of the really, really unique things about crowdfunding that I don't think has ever existed in real estate syndication historically. One of the other pros is getting more exposure to geographies and property types. So you're an investor who's in California, you can invest in New York, Texas, Florida. Eventually, I think this is going to be a global market. So I agree with a lot of the speakers. Oscar, for example, brought up how he thinks there's going to be the ability for cross-border collaboration and cross-border investment, and I entirely agree. So hopefully we can have a worldwide regulator someday who makes these decisions for us. That being said, I am probably one of the most negative crowdfunding CEOs. I really am, and there's a ton of things that scare the living daylights out of me about crowdfunding. And I'm happy to dive into those a little bit deeper in the Q&A, but I always want to share the other side of the business. And there's definitely cons in crowdfunding. And in real estate specifically, one of those cons is you don't have control. The investor is not making the day-to-day decisions on the property. They are along for the ride. There is a business plan. They hope that that business plan gets abided by. There is due diligence up front. They're supposedly working with high-quality companies or high-quality real estate companies. But the investor is a passive investor who owns a fractional piece of a property. So let's say that we have 1,000 owners of this hotel. 1/1000th of a decision is not going to get you anywhere. And that's one of the real cons about real estate in the crowdfunding world. The other is this is completely illiquid. So we ask our investors to sign a specific risk disclosure that they understand all the risks. One of the massive risks is that this is illiquid. It is not the stock market where you can buy it at 8 o'clock in the morning and sell it at 5 p.m. the same night. It is just not going to happen that way. We've known and thought about this a lot, and from the first day that we ever did one of our properties, of the 23 that we've now invested in, we included a transfer provision in our documentation. So if you want to transfer out of one of our assets, we charge you a $500 admin fee, we'll help you get out, but there's no market to get out. And there's also a regulatory hurdle in the US today that you cannot sell a private placement security for the first year. So for the first 365 days, legally you cannot sell, you're in it. Thereafter, in our documents, and it depends on each company that you're working with, but in our documents we said, if you have a ready, willing, and able buyer, we will facilitate the sale for you. And I think that that's really interesting in real estate crowdfunding. I have people ask me a lot, well, aren't you guys just going to build a secondary market, and won't that happen next year in 6 months? It will happen. It will definitely happen, and if there's an opportunity, we will be a company that builds one, but you have to have a really, really, really robust primary market to have any liquidity in the secondary market. And you look at companies like Lending Club and like Prosper who use a secondary market, and until they got to $1 billion in loans, there wasn't a whole lot of liquidity on that secondary market. So it's going to be a long time, I think, for that secondary market to come into fruition. So the other two I touched on, which is you're not deciding when to sell the property as an investor, and you're relying on the real estate company to act in your best interests. So real quick, from a legal perspective, what are investors actually owning when they buy into a project with us? We structure all of our investments as what's called special purpose vehicles. It's either an LLC, a limited liability company, or an LP, a limited partnership. And investors are buying interest in that entity. So they own a piece of a legal entity. That legal entity, in turn, owns the real estate. So there's one step or two steps removed between all the investors and the real estate. Frankly, I think this is the easiest way to structure it. We spent a lot of time thinking through structuring in the US market. I think you've probably got something very, very similar in Canada that could be structured this way. And it reduces liability for your investors. So we don't cross-collateralize any of our properties. If the hotel that we invested in doesn't perform as we expected, it's not going to impact the retail shopping center that we invested in a week later. We keep them very, very, very segregated for investor protection. So how do we invest passively as a company? Really, what are the operations of our business? For me, it's all about the people. And I don't care what business you're in, I don't care what business I'm in for the rest of my life, it's always going to be about the people. We are looking for best-in-class real estate companies that are run by best-in-class operators. What that means for us is we're typically looking for companies that have done over $100 million in real estate transactions. They have a very, very deep history, a very, very deep track record. This isn't their first rodeo. We like to find real estate companies that have been through a bad cycle. So they've been through a recession like 2008 and 2009. They've also been through a really, really good time. And what we want to see is they're not acquiring at the height of the market, and they're not selling properties at the bottom of the market. We also want to see that they're thriving in the bad times. Or if not thriving, they're at least surviving, right? So they're not giving properties back to the banks. We're always looking for character. So we underwrite all of the real estate companies that we work with, both the people and the operating company, and also the real estate. And one of the things that we're underwriting for is character and culture. It's a very, very, very hard thing to underwrite for because there's no metric that defines that. But we'll look at their pro forma, for example, and see, are they growing rental income as quickly as they're growing expenses? Are they making assumptions that seem very out of line in the market? One of the beautiful things about real estate is that there is a lot of data. So we can pull data from other sources and use that to validate assumptions that these real estate companies have. Are they acquiring the property at a purchase price that we think makes sense, for example? From there, we open it up to our investors to invest. We require all of our investors to make the investment decision on their own. So every time they go to look at a specific property, they're making that investment decision on their own. We do due diligence as a business, but the onus rests on the investor to make an informed investment decision. And we provide them access to all of that due diligence information. The last step is sending out cash flow. So sending quarterly or monthly distributions to all of our investors. We're currently doing that on all 23 transactions that we've invested in to date. This was a really, really interesting study for me, and I wanted to share it because I was kind of mind-boggled when I first saw it. But we are focused on high net worth individuals today. Crowdfunding is opening up this to the retail market, I think in Canada and the US and around the world. But who used to invest in this kind of stuff? We came across a study from MIT around institutional investors, pension funds, endowments, sovereign wealth funds, those kinds of things. And on average, within their real estate allocation, 5% of that was going to publicly traded REITs, and 95% was going to direct participations or private placements in real estate. These guys have known about this forever. They've been doing this for as long as we all can remember, and yet there's been very little access for the retail investor to have direct access to these private placements. Just thought this was a really, really interesting stat for how big I think this business can get and how big of an opportunity it is. I think it is for retail investors who have never had access to these kinds of investments. This is another frequently asked question, so I figured I'd address it up front. How is it different than a REIT or a real estate investment trust? Real estate investment trusts are traded, bought and sold on the public markets. The big difference is that you have more control and more transparency in what you're actually investing in. You can choose to invest in this hotel or an apartment building on A Street and Z Street. So you have more control about where you're investing, and you also have more control about the geography that you're investing in. If you're in Montreal and you want to invest in Montreal, you can just invest in Montreal. If you're in Montreal and you want to invest in a property in Vancouver, you'll have that ability to really self-select. The other interesting thing is taking advantage of the markets. So REITs are such large entities now, hundreds of millions of dollars to billions of dollars, that they have to place really, really large tranches of capital. Most REITs won't look at a property, unless they can invest 10, 20, 30 million dollars. And there's tons of opportunity that is below the institutional level right now. Every single equity transaction that we've done on the platform, and I'll share a couple examples, has been an off-market transaction. It has not been publicly marketed widely. And I think that that's a big differentiator with crowdfunding. So I'm in the real estate business. This is a little bit off topic for crowdfunding, but I thought I'd share 5 insights on the market, on the real estate market, that we've come to after analyzing 700 million in private transactions. The first one is that development is back in a big way. These are US statistics. They're probably a month or two outdated now because the US Census doesn't get updated that often, but massive, massive development coming back. That gives you some indication of where we're at in the real estate cycle. Development comes back in the good times. It's typically very quiet in the bad times. We're staying entirely away from development. We won't touch it. I think there's too much risk in it for our investors, and we're focused on cash flow. But it's back, so know that it's back, and that there's opportunity there. The second one is that purchase prices for multifamily properties are leading us to believe that the multifamily space is overheated. This is not in every single market. This is somewhat market specific, but we're seeing properties that used to trade at an 8% return in Texas trading for a 5.5% return. And we have real estate companies pitching these to us, and there's a kind of a joke inside the office that I just say, overheated. So our underwriters will send me stuff, hey, I think this is really interesting, here's what the comparable cap rates are, here's what the comparable purchase rates are, and I just write back one word, which is overheated. And this is really a concern of ours. It doesn't mean that we're not investing in multifamily. We are, and I'll share a multifamily transaction that we invested in, but it means that we're very, very, very cautious about multifamily right now. The third one, this is kind of the doomsday prediction, really concerned about another credit crunch in the US market, but it's a global market now. So in the global market, around 2015 to 2018, you've got a very, very high proportion of commercial loans. So the last kind of blow up was in the residential space. Now I think that we've got a problem in the commercial space where you've got a ton of commercial loans that are resetting, or are going to be coming to market rates between 2015 and 2018. What that means for us is that we're investing in transactions that have really, really long-term loans, 7-year loans or 10-year loans, so that we can lock in interest rates today as well. Interest rates are historically very, very low. Number 4, we're very concerned about government tenants. There are certain government tenants that we're comfortable investing in and around, and there are others that we won't touch with a 10-foot pole. We just said no to a really big government transaction. This is actually a funny one. We got a triple net to the United States Post Office. The United States Post Office is broke, dead broke, bankrupt, and it was pitched to us as credit quality of the United States, highest possible credit quality. Your investors are going to love this. Can't wait till you pitch it to them. And I called the guy personally and said, the post office is broke. The post office has no budget. The post office is closing. You know, you're out of your mind if you go forward with this transaction. So perfect example of where we fit in the underwriting scope, and also some things that we just won't touch. The non-doomsday prediction, there's always opportunity. We're seeing tons of opportunity in the real estate markets right now. In retail, we're doing a lot of retail transactions. Student housing, we invested in mobile home parks, another interesting story. We invested in a mobile home park transaction. It was one of the earliest transactions that we did. And about 3 weeks to 4 weeks after we invested in it, one of our investors forwards me an article from the Wall Street Journal. Carlyle, which is one of the largest institutional investors, has now announced that they're doing a very, very massive mobile home park strategy. So we were on it shortly before them. Perfect example, again, of retail investors being able to either preempt or ride the wave along institutional investors. So we really like the mobile home park space. Pools of single-family homes. I think there's still opportunity in residential. Distressed sellers for multifamily. So because we think that multifamily is a little bit overheated, we're looking for unique situations. We're looking for distressed sellers who have to sell due to a bankruptcy, due to a divorce, due to whatever it may be in people's individual lives. And the last one is loan assumptions. Because rates are so low, we're looking to lock in loans that are assumable. So if we want to sell a property in 5 years and we've got a 10-year loan locked in at 3.5%, that could make it a very, very, very attractive acquisition for the next buyer. So we're always thinking about, what's the exit strategy? How do we get investors' capital out of these transactions? So here's some transactions that we funded. This is the apartment deal in Texas that I was mentioning, with the group that's done 11,000 units, predominantly in the Texas market. It was a 267-unit apartment building located outside of downtown Dallas. I think it was close to 90% occupied when we purchased the property. The objective is to bring up occupancy, but distribute rental income while we're adding value on the property. This is a 72-unit townhome community. This is also very, very well occupied. This is an example of us actually going alongside a government tenant. This is right outside of an army base. The government recently spent $2 billion renovating the army base and getting ready for a couple 100,000 additional troops to come into that army base. So this was an example of us getting comfortable with, it's not a government tenant, but the government, which is the army base, really provides a tenant base for the property. Here's a pool of 10 duplexes. So this was a debt transaction. We were paying investors 9% interest on this. We held 10 loans secured by 10 duplexes in the Tennessee market. This one is probably my favorite transaction that we've closed to date. It's the first shopping center that has ever been crowdfunded in the world. So we're really excited about that. CBS News covered it, NBC is covering it. Major tenants, Safeway, CVS, Starbucks, McDonald's, Subway. Your average investor investing $10,000 or $25,000 would never have the ability to buy this on their own. So we had a lot of demand for this transaction. It sold out in less than 24 hours. So crowdfunding, you can have really rapid activity, and we definitely saw with this transaction. We really like retail, but also people could relate. And I think in crowdfunding, you should be looking for what folks can relate to. And in the US, when you say, do you want to own McDonald's and Subway and Starbucks, people go, oh yeah, I know those brands. I go there every day, right? I get my coffee from Starbucks every day. So they understand those brands, and they really could relate to them. With that, here's my contact info. I'm always happy to answer questions and lend a hand. I'm very focused on relationships, so always try and give back first. If there's introductions I can make for anybody in the room or experiences I can share, I'm happy to do it, and I'm happy to take questions.